Or hurts to have two copies.
Have two, yeah. All right, why don't we go ahead and start? And I think people can sign in as we go. So welcome everyone. It's great to see people. People are still logging in, but that's fine. We'll go ahead and get started. My name is John Brocht. I'm the president of the AU chapter of AAUP. And I just want to welcome you. And basically, I'm going to turn this over to Dr. Howard Bunsis, who is a faculty member at Eastern Michigan University and has been doing a comprehensive budget analysis. And I really appreciate his willingness to take this on. I was looking back, and this whole thing started back in August of last year when I reached out to him just on a whim to see if he was available or had time, and he was extremely gracious and has been super helpful through this whole process. And he's been doing, I think, a monumental amount of work. So I don't want to take his time. I will basically just turn it over to Howard and take it away.
All right, thanks, John. Appreciate all the support. You guys have been great. Good working with you guys. Maybe someday I'll get there in person. That'd be nice.
Yeah.
Deliver these things in person. They keep going on, and done a lot of these, and certainly love coming to DC. When I was AUP, when I was involved in AUP leadership, I was there 4 times a year, and I'll be back in May for a family wedding. So how do you like that? Looking forward to that. So anyway, there's a lot going on here, and so here's the way I think the people who are on here could best be served. There's words, there's tables, and there's graphs in this report. I'm going to tend to focus more on the graphs with some allusion to the table, and obviously the words will mostly come from me speaking. But if you guys have something you want to urgently ask about, you can use the chat or just talk. It doesn't matter. And obviously we will have time at the end for formal questions, but you guys could ask during the time also. And so let me start by saying, I really struggle a lot with this first, like, what words do I use here? And I think decent to solid is pretty good. And I think the A1 bond rating, A1 for a private institution is pretty solid. It's about what I say, but it was downgraded in November of 2024, which is why we're here. Because the university administration is nervous, and I'll point out what the things I think they should be nervous about and what things they shouldn't be nervous about. So the good things are always generating positive cash flows, a lot of cash and investments and reserves. The big challenge, of course, is enrollment. American, as a private institution, does not have a state appropriation to rely on as a revenue source. So the revenue source is going to be, as we'll see, tuition, grants and contracts, research grants and contracts, regardless of where anybody thinks those are all heading. And then the endowment supporting the interest from the endowment supporting operations. But enrollment, American is still a university that relies significantly on tuition revenue, and declining enrollment is always going to be an issue. And as we'll point out, a lot of this has to do with international enrollment. The cash flow margins are solid, but they're declining. So this is what's got these two challenges have got the administration nervous. Some other just big point summaries: the endowment's grown from $700 million in 2019 to $1 billion today. And in addition to the endowment, there's another set of investments that have nothing to do with the endowment. The endowment is the formal way you raise money, where donors give money and maybe put restrictions on that money, or we give it to the biology department, or you can't spend it until my daughter graduates. Whereas the second investment account is just generated. It's there because the university takes in more cash than it spends every year, and it invests the surplus on its own. There's nothing wrong with that. In fact, it's the way most universities operate. But universities tend to understate their true wealth by ignoring these funds. And in terms of where the money is invested, hedge funds this is where everyone's going these days, but the returns haven't been great. to say the least. In terms of peers, American has a smaller endowment than most peers, but generally in the middle in terms of enrollment size. Because of the endowment being lower, you rely more on tuition revenue. Uh, you may not think your tuition is that low, but you still charge less than most of your peers. And surprisingly, I don't. I'm not going to dwell on this in the presentation, but certainly I'm not going to shy away from this either. That your salaries have not kept pace with inflation, and that your uh, salaries are below that of peer institutions. And it's just the way it is. Uh, Most of my report is mostly this is the way things are. I mean, I think at the end we could talk about what to do, and I certainly have thoughts on that. But most of what you'll see in this report is what is going on, what is happening. Uh, there's definitely been a decline in tenure track assistant professor hiring and an increase in non-tenure track hiring. This trend is universal around the country, and a significant reliance on part-time faculty. American is obviously in a major metropolitan area where there's a lot of people who just teach one class and makes it uh, and there's nothing wrong with that necessarily. The issue is how much you be relying on part-time faculty. But obviously there's an administrative issue here, as we'll see, in terms of the dollars being spent on administration. This is kind of the table of contents just to, as you read the and this report you'll have so you can refer to this. So first, the revenue distribution, and it looks kind of wow. There's a lot of reliance on tuition. First, the red is 2021. That's the full year of the pandemic. You could see tuition revenue went down quite a bit, as did auxiliary revenue. Uh, there was an increase in grant revenue, but not all that much. But you can see these other factors don't matter that much. Endowment investment return, contributions that are free to be spent, investment return outside the endowment, net assets released would be more. A release would be okay, the 20 years is up where you couldn't spend the principal. Now you can go ahead and spend it. That's what that is. Uh, and so not much executive education, a little bit of the sources, and indirect cost recovery where there's they're changing the rate. Well, you can see how little it means in terms of the overall scheme of things. And these are the numbers behind the graphs. So just to put some numbers on this thing, $700 million operation in terms of total revenue, 400 million and change coming from tuition, another 114 million coming from auxiliaries. Auxiliaries, housing, dining, that dominates it, housing and dining. But also student union, bookstore, parking. Sometimes they throw centers in there. There's athletics, though American is not playing Division I football. You guys do play basketball, but athletics is in there. But this is mostly housing and dining. And this drop is because of the students not being on campus during the pandemic year. So this is the 24 revenue percentage distribution, this pie chart. And this blue is obviously big. It's 61%. And when Moody's and Standard and Poor's, when they examine, discuss, assign ratings to universities, they typically combine the blue and the red. The auxiliaries are housing and dining. As wonderful as the food may be in your dining halls, no one comes to American who doesn't work there or live there to eat the food. Uh, it's not a restaurant where people, I want to hang out at American's dining hall and eat. That's not what goes on there. It's not really an outs. It's very tied. The point is the red is tied to the blue very strongly, and so that's what it's looked at, and that's pretty. As we'll see, that's pretty high. 76% reliance on tuition and auxiliaries is pretty high. And there was a lot of other slices, but they're all less than 7% to the pie, all these other, and that's what's reflected in this bar graph, I mean, this column graph as well. What's got the administration nervous is the following. It's not so much the pandemic, it's these right here. It's the decline in tuition revenue from 22 to 23 and from 23 to 24. This little, it's not much of a downward slope, but that little downward slope, which reflects a 3.2% decline in tuition and fee. Tuition and fees net means after discounts, after financial aid, what the university takes home in cash, and a 1.6% drop here. These two were very pandemic affected. minus 10% drop, a 15% increase were very much affected by the pandemic. That 330% increase is because auxiliaries basically went close to nothing. But it is promising that auxiliaries went up here, and we'll look deeper at enrollment as well. And looking over the 5-year period, uh, we see a 5% increase in total revenue, tuition up a little bit, auxiliaries up more. I have these in little fonts because the reason I have these in little fonts is the revenue items are so small they really don't matter. So these percentages, these large percentages, overstate the true change. I think the dollar change is all that matters. So this is another way of looking at the tuition. You could see the big changes from the pandemic, and these two is what got the administration nervous, different from what it was before the pandemic. So here we go. So let's dig right in. Uh, and so I use a bunch of different sources here. All this stuff came from the audited statements, and the audited statements it's this document, and the ones and years prior. This is a 30-page document, which isn't very long, by the way. They don't give you, it's basically the statements and a couple of notes. But this document is to show you the source audited by PwC. There's a balance sheet that I use, and there's basically the income statement. It's called a statement of activities. The balance sheet is called the statement of net position. But these two statements, these two financial statements that I'm showing you on the screen now, are the major source of what I use here. There are other sources, and as you can see for enrollment, I'm using what's called the common data set, the fact book, a data book, IPEDS, which is the federal government's collation of data from the U.S. Department of Education. Uh, you've heard a lot about. You guys live in D.C., so I don't have to tell you what's going on, but you've heard the Department of Education may be removed, whatever. Myself and others who do this research, we are very concerned that the people who do this, who work in IPEDS, there have been significant changes in the personnel there. We are concerned that this data is going to dry up no matter what, which is very disturbing. I'm not taking a side politically. I just think that that's been collected that we could use to analyze what's going on in the world. I just think data should always be public, and not having it would be detrimental. So if you guys have any influence there in DC, try to keep the Department of Education open, if I'm allowed to make a plug for that. You guys may. Obviously, I know people have different views. I'm not putting my views on that. Okay. So undergraduates and grad tuition includes law. You can see your undergrads are 60%, 60.7% of the total. Fall 24 is fiscal 25. So it took us a while, as John knows, and John was very helpful in all the data stuff. It took us a while to get all this data, but it says here, combining all the sources, we finally got to the point where we got the most current enrollment data that's out there. American, like most private universities, treats enrollment numbers like national security secrets. So it's not like I could just go to a website and read it. You have to, yeah, it should be that way. And it is that way for public universities. But American is not unique among private universities to treat enrollment numbers as if they are proprietary. So anyway, you can see the general decline, and you can see the big decline in graduate enrollment. You can see it, and we'll look into the numbers. But undergraduate numbers not doing as well either. So I changed the scale here. So this, just to show you the way you could use data and graphs differently. Here you have the scale starting at 0. Here, the administration's view is change the scale, and it looks like enrollment has gone to like 0. It looks like you have 5 students left. But actually you have 12,000, but looks like you have 5. So this is what's getting everybody nervous. So this is it by level and looking at the changes. So you can see the changes the last 2 years right here, right, these numbers here. Undergrad, 100 students drop, 300 students drop, and then from the grad students, though, a much more significant drop. The majority of the drop in the last 2 years has been among graduate students, as opposed to undergraduate students. And you can see the percentage change in graduate student enrollment, again, is significantly in terms of it dropping. And that this downward slope has definitely got them. So we're going to look into it even more. So this is just the annual percentage change. Again, this is very pandemic related, these two, and these three are where we are now. Uh, so why did enrollment go down 6.2%, but tuition revenue go down only 1.6? To review again, what matters is what they take home. So again, I said, sorry to go backwards. These are the numbers that got them nervous, these guys here. This is what they take home. Well, tuition is like a stew where you put a bunch of stuff in it. And we have the tuition price, we have the discount rate, the mix between grad and undergrads. Undergrads tend to get more financial aid than graduate students. They also get, there's definitely a lower tuition level as well. In terms of the discount rate, the discount rate is, this is the sticker price. The number, the first row is basically what all the students, grad and undergraduate, are charged before any financial aid is considered. Then the scholarship allowances, and this is what they take home. The 32%, you can see I've done the math, just bear with me here. It's this 200 million over, these are in thousands, 200 million over 630 million. So it's about a 32% discount rate. It is higher than in prior years, but going up roughly more or less 1% a year for the last 5 years, maybe a little less on average, but still going up. Not huge increases, but still. Uh, is this buying students? People use that phrase a lot. I don't. I don't know about that. 32%, and we'll see the tuition levels are not low here, and we'll compare it to peers as well. All right. In terms of long-term changes, so everything I did up to now was annual changes. Now let's try to look at things a little more long-term, going back before the pandemic again. 3-year period, 19 to 22, things are looking good. So it's since the end of the pandemic that things have not gone well. Uh, and you really see it. That's why breaking it up like this, I think, is very helpful. And you really see it here, and you really see how the grad enrollment is driving. Not that undergraduate enrollment is doing wonderfully, but grad enrollment is certainly driving a lot of it. And that's what you see here. Okay, so digging even deeper. We only have data through fall 23 or fiscal 24, but you really see how much international enrollment really affected things. Look at the international enrollment. It went down from 19 to 24. It went down 443 undergrad students, 95 grad students, 535 other. You can see the percentage change in undergrad. This is just on international students. But still, these big drops, this 143 student drop over that 5-year period. If you look at the big picture here, sorry to go back again. But if you look at the big picture, you get the numbers here. From 19 to 24, the overall drop is about 1,300 students. More than 1/3 of the drop in enrollment, is international students. Close to 40% of the decline in enrollment is due to the decline in international students. That now, the reasons for that is something that all of you guys are on this call on a Friday afternoon. It is Friday, I think. And so obviously you care a lot about the place. The reasons for that are maybe multifaceted. Maybe you weren't aware, but it's my role to tell you this is what I see. I don't always see this. Uh, I think John and I in our discussions, I don't always look for this because it's not always obvious, but I think John or someone else there pointed out maybe you should look at this. And so here we are. So someone there knows about this. Some of you are aware of this, is my point. And this chart, eesh, eesh, that's all I can say to that. And I don't know if the people who run the place, they have to be aware of this, obviously. What are they doing about it? Uh, what have they told you about it? Uh, so much of why we're here, of why you guys brought me in to do this, is because of what is on this screen right here in front of you. I don't always say that. Every situation is different, but so much of it is because of this. If you take out the international enrollment drop, we're in a different place. I think we're in a different place. It's also probably the case that international students probably get less of a discount. You're so yeah, and you can see the graduate international enrollment is lower to begin with, uh, but still declining through here, but increased the last two. So we don't have the 25 data yet for, well, it's out there. It hasn't been made publicly available. What was the international enrollment for the year we're sitting in right now? That data has not been made public. Well, not to me, but it's out there. I think in terms of what can you guys do following up, I want to know where I want to know where this is for 25. I want to know where international enrollment has gone. Has has this decline continued or has it reversed itself? That's what I would like to know. The common data set, let me see what's in the chat here. Is this report available to you? Uh, I I will send you this. I'll send you a Word file and a PDF of this document. I promise. Uh, and the common data set is the source that reports this, among other sources, but this is the one that has, and that common data set is, as we sit here in April, it's definitely been done. I just hasn't been put on the website yet. Hopefully it will be. And but someone there knows, someone who works there knows what's going on here. And that's how you can, what's going on here? Did this change? Did this reverse itself? Okay. I'm going to break down the expenses in four different ways. Now, you may say to you, I know, you guys are not accountants, probably none of you are. And people, when you talk about budgets, and as you see, I'm not analyzing the budget, by the way. I'm analyzing the university. Yeah, someone's right. Yeah. People, okay, so a lot of people talking in the chat about reasons. So people in the chat now are giving reasons. If you look at the chat, some people are chiming in with some reasons why the decline is there, and maybe there's nothing that can be done about it. But I think it's important that we know that it is a major factor in terms of what's going on. So in terms of the expenses, why can't we just have one simple way of doing this? This is not, we're reporting what actually happened, and there's four different ways we can break down the expenses. One called the functional expenses, where you break down the expenses by what people do, whether they teach class, whether they run the dorms, are they administrators, are they librarians, do they do research, are they academic advisors or student counselors, do they work in the media arm of the university? That's the function one. This is in the audit, and in terms of what these categories are, institutional support, as I write here, is pure admin. You have the unions on campus. Obviously, the faculty is not unionized, but there certainly are unions on the campus of America. Some of the workers are unionized. Uh, and again, this is not a call for faculty to unionize. Faculty at American are not unionized and are not able to unionize because of Supreme Court precedent that is not changing with the current Supreme Court. I think I can say that. I'm not making a statement here. So let's see. So I'm looking, as you see, I'm scrolling the chat with you, and that's all very difficult. So that's very, very unfortunate, all of that. So this is the expenses. So about a third of the expenses go to instruction. You can see it's declined a little bit over time. That's the first way of doing it, first way of breaking it down. This is the percentage of expenses that go to instruction, the percentage of expense that goes to administration and all the other various categories. Most people think, faculty are 90% of the cost. Well, no, not quite. There's a lot of other things that go on. Uh, and this is the distribution itself, and you can see how things look over a 6-year period, which is, I don't, usually we do these in 4 or 5 year bouts. We usually do these in it because when you get further back than that, it gets a little squirrely. But the reason I always go back to 19 is because the pandemic makes you go back to 19. So I know this is a lot to.
Howard, can I jump in and ask
Yeah.
really quick? We had a question. What do the auxiliaries indicate here, or what are these categories? I guess
Auxiliaries
you're probably
are
going to get to that.
housing, dining, student union,
Hmm.
books. That's auxiliaries. That's what auxiliaries are. And I think I said that before, but I wouldn't listen to me either. Uh, so that's what auxiliaries are, and it's mostly housing, dining. It's dominated by housing and dining. People, students, undergraduate students living on you. You must have dorms there. I assume you have dorms on your campus. Yeah, yes.
And
And the students,
yes, we do. And Amara was asking, does that include then contracted dining, residential staff, et cetera?
yeah, includes all the expenses associated with feeding people, feeding the students in the dorms. It includes all the people who work in housing
Mhm.
and dining. Uh, and
Yeah, has her hand up.
it also
Creative.
includes parking. If you have parking attendants, it's going to be in there. Uh, if you have coaches in sports, they're going to be in there.
Mhm.
Uh, there's a whole bunch of stuff that's in there uh, for that. And
Priya
I
has her hand up. I don't
Yes.
know.
Sorry, I have an echo.
Go ahead. No, okay. Uh, there is an iPad. I'll put this in the chat. There is an iPad's glossary, which I sometimes quote. Probably should have quoted it. There's a glossary that has all these definitions. Some of the definitions aren't. They're kind of formalized and they're not the most helpful thing in the world. But if you just type in iPad's glossary to Google, you'll see formal definitions of all these things. But just to tell you, auxiliaries is housing and dining. Institutional support is upper admin. Academic support is librarians and deans. Why they put the deans in with the librarians is beyond my comprehension, but they are. So I know this. My guess is there's some librarians on this call. I doubt there are deans here or associate deans, but you never know. Uh, so
Sorry, this is Priya. I just realized I was on mute. My quick question about the auxiliary services is that does this like also include? I mean, those services are also like a contract revenue stream, aren't they? So for like, for
auxiliaries are
example,
revenues and expenses. They're both
the revenues and expenses, and so the 16%
expense side. So
is the expense
here's the
side.
revenue. Here's the revenue side. So they bring in $114 million in revenue. So they brought in 114, 150, let's just say $115 million in auxiliary revenue in 24. Now on the expense side, which we'll get to right now, this is what you're asking about, almost the exact same thing.
Okay.
So it's both a revenue and an expense. Typically they make money.
Yeah.
Uh, Now that gets broken down. You could break, auxiliaries gets broken down into housing, dining, parking, student union. Sometimes there's a conference center, maybe there could be a hotel associated with the university that they run. Uh, Parking, athletics is in there, and that's always running a deficit because athletics just has. Don't take us the wrong way. If you guys play sports, which I assume you do, no one's probably paying to go to the games, but so athletics is basically all expense, no revenue, and that's part of auxiliaries too. Uh,
Got it. Okay.
Now that it would be, I mean, what's broken? It's none of the auxiliaries numbers are broken down in the audited financial statement. There's just one number. If there's a budget that breaks that down, that budget is not publicly available.
Mm-hmm.
My guess is you guys don't see that budget either, breaking down auxiliary into housing and dining. But to me, if you guys, since you brought this up, it's a legit point. If I were where you're sitting, I'd want to know from the administration. I want to know exactly what's in the $115 million on either side of auxiliaries. Could you tell me what's in there? Could you, administration, because administration, but you're not telling, it's not made public. So could you tell us? And that's one of the things an AUP chapter can do. An AUP chapter can get together and say, okay, we have this report. We want to know more, administration. Here's a list of things that we would like to know because we just think it's important for everyone to be involved and everyone to know. So that's the way I'm starting to get ahead, but you brought that up, and I think to me that's one of the things I would want to know is what makes up, like how much is housing, how much is dining? Are you making money on housing and dining? Are you losing that much on athletics? These are things they could tell you very easily, but whether they do or not is another story. But the only way they'll say this, the only way you'll ever get anything from them is if you do it collectively, is if you ask, yeah, someone's get the iPad link there and the definition for auxiliaries. Yeah. Residence hall, food services, student health, and collegiate athletics. Yeah. Athletics, I don't think there's much. Again, I'm not being insulting. I just don't think people pay to go to your games. Maybe I'm wrong, but I just don't think that's happening at American. Uh, my brother went to Georgetown. A little different story. You know, their basketball. He went there the Pat Ewing years. My brother went to the same 4 years. You guys are too young to remember Pat Ewing. I played basketball at Georgetown. It was a very different time. But that's a different place. Okay, so here's the pie chart on the expense side. This pie chart is different than the other pie chart. The other pie chart was dominated by tuition and auxiliaries. This one, a little more even for everything. Got a lot of different things going on. This is very typical. A university's pie chart. I do this for every place. Yeah, they're all different, but they don't look all that different. I mean, every university is different, but these percentages change, but they're not all that different. Universities, we hardly ever get pure instruction up to half. We never quite get there. So, uh, okay. So let's,
To defend ourselves. We intend to defend.
sorry. All right. So the second way of breaking things down is what's called the natural classification. So you have the functions, which you guys were all asking about, and then you have these natural class. These are almost self-explanatory, except for one big deal. The one highlighted in yellow, professional services and fees. There is no, like iPads has a glossary, and everyone kind of works with those definitions. These definitions, what American puts in their natural classification is up to American. The functional categories are pretty standard because we have this iPad stuff and they're pretty standard. These are not standardized. I do not see this. You see it some in the private sector, but not always separated out. And the number is humongous. And we talked about this a lot in the months leading up to this day today. 17% of the expenses, one of every $6 that American spends goes to professional services and fees. Now, they're not all consultants. Uh, First thing I'm doing, if I'm you guys, I want to know what's in here. I want to know what could you tell me what makes up this $123 million? Is it outsourced? Is it does that include the what we pay to outsource dining or housing? I kind of doubt it, but that should be an auxiliaries. But who knows? I want to know what's in this thing, which has gone from 109 to 112, pandemic 85, 115, 130. That's $123 million. It's really unbelievable to have one of every $6 go to the outside. Theoretically, sorry to bring this up, these people could be employees. These functions, the people who are producing this function could be employees. I think, John, you had mentioned, if I'm not mistaken, a consultant for admission that the university had hired.
I don't know if a consultant for admissions, we have
Or
consultants for budget trimming and for all
yeah,
kinds of things. We have consultants everywhere.
yeah. But I mean, again, I think, look, let me be blunt here. The conversation that they want to have with you is things are so bad, we need to cut. And could you just help us cut? My view is, first of all, things aren't that bad. Secondly, before we start cutting anything, how about telling us what you're spending your money on? More so than the categories tell us. I mean, we could tell from these categories, but I want to know, why are you spending $123 million on consultants?
So Howard, we've been asking that question quite a lot. We don't have transparency yet, but what we have been told is that some of these contracts, some of the large ones, are actually housing and dining, which seems like it should be under
Auxiliaries.
auxiliaries.
You know what? I don't believe that. They can say whatever they want until they show you. I want to know
Yeah.
I want to know the top 20
Mhm.
items that comprise $123 million. If it was housing and dining was in there, they'd be in the top three. They'd be right at the top. So
Mhm.
let me know. That's what I would tell them. Let me know what's in here. I mean, I don't want your word for it. I want to see, just show me the numbers. Uh, this here, 56% to salaries and benefits. You always hear people at a place, at an educational institution, people are 2/3 of the cost. Just looking. Yeah. A lot of people, yeah, they don't want employees. The reason they don't want employees is because they don't want to pay you guys retirement and health. That goes without saying, almost. So, but this is on the lower side, but not off the chart. So it's definitely on the lower side of things, that 56%. So, okay, third way, salary and benefit components of the expenses. So we're taking the functional expenses. So think of instruction. Instruction's got paying your people, and then it's also got the projectors in the room, all the paper from for the copier that you need, you need to make copies for your exams, things of that nature. So this third breakdown is saying we're going to look at salary and benefits of each category. So take out the supplies part, take out the utilities part of these expenses, and just focus on the personnel part of these expenses. And this is what you get. And you get a fairly similar distribution to what we saw before. So salaries and benefits, that's the 56%. But right here, instruction is 38% of everything in terms of salaries and benefits. And they combine institutional or auxiliary in one. Their combining of categories here makes it really difficult. They combine a bunch of categories when they do the salaries and benefit stuff. So it's really hard to make inferences. Plus, the benefit stuff is all estimated, and the benefit rates, it's hard to know what they are. So to me, the pure way to look at this is to look at the salary only component of these expenses on iPads. Again, this is the American University submits this to the federal government. There's no data yet for 24. It is due in 11 days. This submission, this purple stuff where it says no data yet, is due to the federal government in 11 days. So either it has been submitted or it will soon be submitted. Again, another item on the list. When you go to the IPEDS website, the National Center of Educational Statistics website run by the Department of Education, this will not be seen until January of 26, though American is submitting it in April of 25. So again, I would say to them, could you please share with us? It's about this data is part of a finance submission, which is about a 19-page PDF file. That's all it is. A 19-page PDF file, it would take them about 46 seconds to share that with you. And I would ask for it. That's just me. Because to me, this is the purest way of seeing how they're spending their money. Now, the only downside to this is there's only employees in here. Anything paid to consultants is not in this breakdown because this is only people who work, who are employees of the university, who are salaried employees. And you can see the percentages over time pretty flat. And we'll compare these to peers pretty soon. We're getting there. So here, by the way, these category definitions, they're all in here. So you guys could, I don't know what you do with that. I cut and pasted from my iPad's glossary to here. So, but if you guys were looking online, so there you go. Anyway. Okay. Now, operating performance. I have 3 different metrics. So I had 4 different ways of breaking down the expenses, 3 different ways of determining operating. How they doing, revenues versus expenses. Operating income. So look at just the operating side and not take out the paper gains and losses. The middle one, the change in assets, is what this one here, this very fancy phrase, is net income in the for-profit world. It's all the revenue minus all the expenses. It has all the paper gains and losses on the investments in here, which kind of skews everything, in my estimation. And then this one here, EBITDA, this is probably the one that the bond rating agencies use this third one for the most part. They also use the first one. They do not use the middle one because it's too skewed. But EBITDA, which is earnings before interest, taxes, there's no taxes here, depreciation and amortization, the D and the A, and it takes out all the non-paper gains as well. And this is the way you compute it. This is the way I'm computing the 3 different constructs. And you can see the change in an asset is very volatile. This is the big stock market increase, all these paper gains, and this is the big stock market decrease the year before. And you can see on basically a cash flow basis, things are fairly positive, though operating income is not irrelevant, and that's got the administration nervous as well. is because this one takes out interest and depreciation. This does not take out interest and depreciation. This is more cash flowy. This is total operations. I think the bond rating agencies rely on this one more than that one, but they're both relevant. The middle one, not so much. The middle one, not so much. So here, I took out the middle one, and these are the two metrics. And you can see how they move. They move almost, obviously, they're almost identical, the way they move. But the difference is the green one does not include non-cash depreciation expense, which is an estimate of the wear and tear on the buildings. And this one does, and doesn't include interest. And this one does. So that's why this one is lower. The pink includes interest. The pink includes depreciation expense. They're both relevant. They're both relevant to telling the story of how American University is performing. And this decline in EBITDA was cited by Moody's. The EBITDA margin, this decline was cited by Moody's as a reason for the downgrade in Outlook. Okay, now let's look at the balance sheet. Balance sheet itself is very strong. Assets are growing. Liabilities are low and not really growing that much. And the difference between the two is called net assets. So the green plus the red equals the blue. And some of this blue, which is $1.6 billion, are reserves. Not all of it, as we'll show you, certainly not all of it. But in general, it's hard to make, as I write here, sorry to use the words, it's hard to use, it's not important to say, okay, there's a great balance sheet, they're in great shape. You can't, that's too strong. That's just not something you should be doing. But it is positive that assets are growing and liabilities are flat. And so we're going to look into the cash and investments. So I think the picture tells the story. This is the cash and the investments, a little bit of receivable. These are the buildings. This tells me you have not really added a significant new structure in the last 6 years. There's not been a significant new. Now, given where American is and given the it's just not, you can't just, oh, we're going to buy this building and buy this piece of land and build a new dorm or new. You don't have that luxury in Washington, D.C. You can't just do that. So this is not, I just think where you are and where you're located constrains what you're allowed to, what you can do here. But this is nice to see. A lot of this increase was paper gains in the stock market, but things in general have gone well since then. We'll look at the endowment more closely. American uses a phrase in their financial statements to get at how much do we really have free to deal with problems and deal with issues. They use this phrase unrestricted liquidity. And unrestricted meaning unrestricted, liquidity meaning liquid, cashy. And this is what they use. They use a combination of what they call financial assets and board designated funds. Not every place does this. There's other ways to get at reserves, but this is what American specifically does in their audited statements. It's the way American does this. I'm just taking a look at the. I think what was written there. I think the bond rating downgrade was driven by the enrollment decline associated with the decline in EBITDA margins. I do believe that. So they didn't downgrade the rating, they just downgraded the outlook, which is like we're gonna ding you, but not that bad, is the other way of looking at it. So looking at this graph of unrestricted liquidity and debt, well, it's nice to have more liquidity than you have debt. You don't have to pay off the debt. There's no way you're going to pay off. You don't have to pay off the debt in one fell swoop, and you can't use all this money to all of a sudden just pay for everything you need. This is like a savings account. This is like a savings account, which is nice to have. So in terms of borrowing, the borrowings, the two most recent borrowings that American has had are, sorry to use the word, in 2019 they borrowed $400 million, $42 million to pay off some debt and get out of interest rate swaps. Why they were in interest rate swaps is beyond my comprehension. A university is not Goldman Sachs. They should not be in. When you get involved in an interest rate swap, you're making a bet on where you think interest rates are going. American universities should be educating students. They should not be predicting the future of interest rates. No one's that smart, and that's not the expertise that American has. Americans' expertise is educating people. That's what you guys are good at. You can hire the smartest CFOs in the world. I just don't think that should be happening at a university. I do not get interest rate swaps. We sit here today in April 25. Do any of you have a clue as to where interest rates are going in the next year or two? Do you really think anybody has a clue as to where interest rates are going? And you only get into an interest rate swap if you're pretty sure you know. Well, first of all, you never know. And secondly, in today's environment, no way can you know. There's way too much volatility out there. In 21, the last time they actually borrowed any money at all, that's this little guy right here, this little increase right where my cursor is. They borrowed $100 million to what, and this is quoting right from their note, their audit statements, finance or refinance the cost of various improvement projects at the university, to finance certain operating expenses at the university, and to pay costs of issuance. I'm sorry, you might as well have said we just borrowed $100 million. This is telling me absolutely nothing. They don't tell you, usually they tell you what project they're putting the money into, but that's not what debt instrument we're even retiring, maybe what operating expenses they're paying, which not quite sure. But this is a very generic statement that are just not telling us what they're doing with the money. They don't have to, but I think when the university borrows $100 million, they should let us know a little bit more than what I have highlighted here. My dog Roxy, who you can see, Roxy's she could write. She could have written this. I'm not. That's not great. That's not great. I'll just leave it at that. Okay, let's look at the endowment. So at the end of 24, Americans got $1.4 billion in investments, $1 billion in the endowment, and another $400 million in investments outside the endowment. So it's the big growth here was the stock market. But since then, things have been doing well. So I guess on a cash basis, EBITDA being positive, they're still doing well. They're still bringing in, when all is said and done, Americans bringing in more cash than they're spending even the last couple of years on a cash basis. So in terms of the reserves, we talked about the unrestricted liquidity. This was their way of looking at it. So this unrestricted liquidity, $950 million, $700 million in operating expenses. This is called the primary reserve ratio is numerator, denominator, and this means that American has 16 months of expenses in reserve. And that's a pretty solid level. That's a very high level. It was cited by the bond raters as one of the strengths of American was this, and it is. They have a lot of money in reserve. There's no doubt there's a very strong reserve. Does that mean the Americans just spend the reserves down? No, it doesn't mean that. But it does mean that in dealing with what hopefully are temporary downturns in revenue or increases in expenses, we can use these reserves in the short term, but not as an every year basis, but we can use them in the short term. It certainly suggests that it should at least be considered before you start cutting core mission, before you start laying people off. I mean, a place that has almost $1 billion of unrestricted liquidity and starting laying people off, that's hard to square. That's hard to square. We'll just leave it at that. All right, the endowment itself, what moves it? The returns make it go up. People giving money make it go up. What makes it go down is taking money from the endowment, giving it to the university, the endowment giving it to the administration so they could spend it on everything, scholarships, new programs, salaries, everything. It goes in the pot with everything. And so that's the way it works. Now, where is this $1.4 billion invested? Well, level one securities are like mutual funds, fixed income funds, a lot of what you and I invest in. And I think it's nice that American invests more in level one than in what's called net asset value or hedge funds. Hedge funds, today is the opening day for my beloved New York Mets, their opening home day. They are owned by a person named Stevie Cohen. He's probably got a bunch of your money that he plays with, along with all the other hedge fund managers in the world. If it were me, I wouldn't give a dime to these guys, including the owner of the Mets. I wouldn't give him a dime. I put all my money where we put all our money. I just put it in the market and let it go. And I'll show you why in a bit. But more and more going here, though not, I think in general, more than 1/3 in hedge funds is low by private university standards. Most private universities have more invested in hedge funds than American does. I don't know what the rules are. I don't know what the philosophy is. Why is American seemingly, and it is, more conservative than other private institutions? I can't answer that, but I applaud that. I still think this should be zero. That's just me. So how has the endowment performed? Like all the endowments in the private university sector, they have not been able to beat the market hardly at all. They beat the market in 22. It didn't go down as much as the S&P. But in every other year, the gray, which is the S&P 500, beat the market. In 19, 20, 21, 23, and 24, the S&P 500 beat the American University Endowment. Now, the university, the administration will say, that is completely unfair. The market is not our benchmark. Our benchmark are other university endowments. My response to that is, yeah, go ahead and make whatever benchmark you can. But maybe occasionally, could you beat the market? I mean, come on. Could you maybe occasionally beat the market? Do you really have, it's not like a pension fund where they need to be spending cash every year. I mean, we know how much cash they're spending. We're going to show you how much cash they're spending. Yes, they got to help the university. This yellow bar, this yellow line, this yellow numbers here, that means in 2024, 4% of the endowment was spent for the to help with scholarships and programs and things like that. They have spent 4%, which is the highest it was in the last 6 years. That covers less than 6% of the operating expenses at American. Now, you've heard the president of the United States, or well, I don't think he understands it, sorry to say, but others in that party suggest that if private universities do not up both of these percentages, we are going to tax them more than we're taxing them now, which is like 1%. They put in 1% endowment tax. The universities will argue that if we are forced to spend more than 10%, 5% of our endowment on, then our endowment's just going to go to zero. I think that's a gross exaggeration of the truth. But they spend this is so right now, and it's not like, oh, we need the cash to spend. You're only spending 4% of the thing every year. You have contributions every year also. I mean, looking at the endowment, allegedly you pay all these. I mean, someone's giving you money. That's $13 million someone gave you. So I'm not buying the explanation that the reason why we can't beat the market is because we have to support the university every year. You don't use that much endowment to support the university, and you don't support that much of the university. That's what we see here. Okay, bond rating. This is the Moody's rating. It's A1. This chart includes public and private. You can see A1 is, and publics tend to have a higher bond rating than privates because the public's university sector has an additional major revenue source called the state appropriation that American and private universities obviously don't have. From Standard & Poor's, your rating is A, and you can see, and this is a little different than, because this doesn't include the public, and you can see you guys are you're basically in the middle, a little higher than the middle. You can see about half are either BBB or below or speculative. And so you guys are not quite in the first two, but in this middle top category, which is about what I said at the very start as to what my overall conclusion was in the financial condition. And I did lean on the bond ratings because it's the outside confirmation of where the university is really at, besides just me talking about it. And here's some quotes from the Moody's rating. Substantial wealth and unrestricted liquidity. They cite these numbers. They cite the unrestricted liquidity, cash on hand. Management is projecting stronger. So this was done in May of 24. American told Moody's, we're going to get stronger EBITDA margins, though they're still low where they used to be. Note that American University cited budget cuts and Moody's would not have put this in there. There's no doubt about that. And the S&P, they talk about the enrollment and demand challenges. We could revise the outlook to this. They downgraded. This is 1126. They made it outlook, but affirmed the A plus for Moody's. So they kept the rating, but knocked down the outlook. And we could revise to stable if enrollment begins to stabilize. And their strategic initiatives are basically cutting. Well, we'll talk about what's going to get cut in a bit. Okay, let's look at peers. All sorts of different peer groups flying around. And this is what we talked about this a lot, and this is what we wound up with. Group of 27. A mixture in terms of the region. This is the regions they are in. So on this, you can see the regions they're in. Are they in big cities? Are they in small towns? There's a couple in suburbs. There's some in small cities, but there's no. Bucknell and Colgate, the ones I flagged here. You guys have both been to these. Well, I've been to these. Yeah. I'll just leave it at that. Grants a medical degree. American No has a hospital. You see 4 of them do. That changes things generally. In terms of the Carnegie classification, you guys are doctoral high. Used to be R1, but they use these classifications now. Very high and high. And then these, I'm not so sure how good they are as comparables. And in terms of religious affiliation, you have a Methodist affiliation. I don't know how significant it is. There are several here at Catholic. Obviously, Georgetown is Jesuit. And Fordham, I went to Fordham Law School and Catholic University, obviously, and Holy Cross. I don't know how significant your Methodist affiliation is, and that's Roxy chiming in. So, all right, what else we got? Using iPads is the most, it's not the current year, it's last year. The most you had, you charge $56,000 tuition and fees. That puts you 25th out of 27th. I said you were low. The peer average is 63, and the median is about the same. And you guys are 7,000 below that. So you guys charge less than most of your peers. Your enrollment, this is fall enrollment, so it's 24 enrollment. You guys are 11th out of 27th in undergrad, 16th out of 27 in grad, and overall right in the middle of the pack in enrollment, and right in the middle of the pack in the percentage of your enrollment is undergraduate. So in terms of enrollment, you very much fit in with this peer group overall, whatever that's for that. But you do have much lower tuition. The endowment's a different story, and this really is a different story. Johns Hopkins, who I've done work for, you can see that's a $13 billion endowment. I put all the zeros in here, and there's American at $1 billion. This is the endowment per full-time equivalent student. This is what, and I used Nakubo as a management. They're a bunch of university administrators, basically a bunch of CFOs who work for universities. That's who goes to these meetings. But the data is great, and this is the 12/31/2024 endowment, or the 6/30/2024 endowment. This is the endowment at the end of 24, which is the most recent one we got. Fall 23 is fiscal 24, so it's pretty good. Vanderbilt's flag is that's the highest. They have the highest endowment per student at 786,000, whereas you guys are below 100,000. Doesn't mean you shouldn't be compared to Vanderbilt. I'm just pointing out the differences. Of the 27 schools, Americans got the 24th largest endowment, 18th largest in terms of FTE enrollment, and 22nd in terms of endowment per student, per FTE student. And wow, so this is kind of messy, but what I did, this is the salary only distribution per IPEDS. And here's what we learned. Of the 27 schools, American spends the 22nd highest on instruction. The percentage of salaries going to instruction. Administration, institutional support, you're right in the middle of the pack. You're higher. All of these are these categories, which are defined earlier. Public service is basically media Academic support is dominated by the deans. Student services are all the people that work in student affairs, et cetera. These are all basically admin categories. Not as pure as this one, but these are mostly admin categories. And you tend to do higher on the admin categories and lower on the instruction categories versus your peers. Now, because the endowment is toward the bottom of the group, therefore, here's the percent of revenue coming from just tuition and fees for 23, you're towards the top because your endowment provides less. Look who's last, Johns Hopkins. Not only do they have the largest endowment, they also have significant medical research that drives their enrollment, their revenue base. And a lot of the medical stuff, with hospitals, medical schools are down here because they have that. So I took the hospital costs out, the hospital revenues out. But this is because of not having a large endowment compared to your peers. Okay, let's look at some management bloat issues, which I'm sure you all were waiting for, and faculty salaries. So, so we have IPEDS, tenure track, NTT. Sorry, I should put this in the chat. Let's see what we got going on here. It was just classified. Okay. Yeah, it was just classified R1. I used what's on iPads is 23, 24 quantity classification. That's what's on iPads. And so I think what's in the chat is great that it's now 24, 25. It's higher. So NTT is non-tenure track. That's what NTT stands for, whatever that's worth. And you can see the rise in NTT, the decline in tenure track. Those map into tenure track maps into assistants, non-tenure track maps into instructor. This profile, this graph at the bottom here, if I were you working here, full disclosure, I used to be one of these people. I used to be a non-tenure track person. I've been that in my life. I'm not now, but I was. I was part-time. I was non-TT, and now, so I know what this is like. I lived it. My guess is most of you have not or are not, but that's fine. And some of you are, and you know what it's like. We all know what this is like. The security issue is really an issue, is a problem. You just don't feel the same. At least I didn't. Maybe you guys, maybe you have a different experience. But I never felt that secure in that position as a non-tenure track faculty, as a probational faculty, all that kind of stuff. It wasn't fun. But we definitely see, I think the university is definitely moving away from tenure track hiring. There's no doubt. When people get replaced at American University, they tend to be replaced by either non-tenure track faculty or not replaced at all. There is some full-time tenure track replacing, but it's not one for one. You guys tell me if that experience is different. When someone retires, is that line automatically renewed as a tenure track line? I can't believe it is. What do you guys think? What is your experience in your departments? If anyone wants to chime in on that issue.
Yeah, I can't really speak that much to it. Does anyone have any experience in that?
Read a little bit, John. I think that it depends on the school you're in, but some deans don't actually publicize exactly how many lines are out there. So you may lose someone to retirement, but you're not exactly sure, what's happening to that line. Is it being moved around or? So it's hard and it's partly that's just they're obscuring the data so that it's easier for them not to.
Marianne wrote, we have to argue for every replacement. We've had no retirements and no replacements, as someone said in their department. But the data suggests that you're not doing full replacement of tenure track lines.
Howard, can I ask you a question? When you see a decrease in assistant professors, could that just be people getting promoted to associate? And
yeah, I mean, it's more, obviously you want that to happen.
I mean, you want that, but
when they get promoted to associate, there's also the whole cycle is working at the same time. People do retire. I know that sounds impossible for some of you people in your 30s and 40s to believe this, but people actually do retire. And so yes, you do have assistants being promoted, but you also have on the other end associates and fulls leaving at the same time. And when I see assistant professor hiring down, that tells me and that goes in very much in line with the decline in tenure track. Though that is nice to see that little bit of increase there. So my guess is it's mixed. A lot of use of part-time faculty, iPads and common data set generally match. There was a big decline here in graduate teaching. It's unclear to me whether graduate teaching, are they the teacher of record? Are they teaching just subsections? Are they teaching just there's a big lecture and a graduate student's teaching smaller subsections? Or is a graduate student just doing grading? It's hard to know what this category is. Different schools use it in different ways. So anyway, this is what it looks like over time. Grad teaching assistants, but part-time faculty generally up, and non-tenure track generally up, and tenure track kind of flattish. So that's a trend that we definitely see. On the non-instructional employee side, the categories management. I don't know if I put the definitions in here. There's definitions that they use for all these have definitions as well in iPads. These are employment categories. So the other definitions we were looking at earlier, those were functional expense categories. These are people. These are actual human beings going into different categories. And management is the number one category and you can see the increase is significant over time. And these are all the other non-instructional categories that people are in, that people get placed in. And in terms of this is generally your secretarial staff, which at most universities is declining use of secretarial staff. And if there was huge outsourcing, we would see it here, and I'm not seeing huge. I mean, there are definitely numbers in almost all these categories. And this tells the story about management bloat. From 19 to 24, the number of management is up 15%, full-time faculty up 4%, all other employees up 1%, enrollment down 9%. Show them this picture and say why. That's what I would ask them. Why? The dollars. So this is the number of management. This is the dollars paid to these men. The dollars paid for instruction. The dollars paid for management. The dollars paid for all the employees. These are salaries only. This is salaries only. And you can see over this 5 to 6 year period, the dollars paid to management go up 33. The dollars paid to instruction go up 13. The dollars paid to all the other employees go up 18. So the number and dollars paid to management employees have gone up versus faculty and all the other employee groups. That has happened. If there's ever any discussion of cutting, it's so obvious what needs to go first. It's just so clearly obvious what should happen first. But I'll leave that. That's for another day. Is this common? Absolutely common. Unfortunately so. Here I compared the average salaries in instruction versus management employees. So all ranks faculty salaries going from 108. And this, John talks about that mix as assistants become associates and portfolios decline. I mean, that's all part of it. And why are these guys getting more? I don't know. It's hard to explain. They have high salaries to begin with, and they're getting bigger raises than you guys. That's what's happening. All right, here are your faculty salaries. The reason why the full salaries don't move that much is because of retirement. The people who retire, on average, not all, on average, tend to be higher paid. So the higher paid faculty are leaving the full group, being either not replaced or replaced by an associate who got promoted to full is probably, on average, not making as much as the full who retired. They're saving money on all of these swaps and all this changeover. And when a full professor leaves and she is not replaced, so she retires and she is not replaced by a tenure track line, that's going to be, you're going to see that in both the number of faculty data, and you're going to see it in this first line here. When she leaves that full professor rank and her salary was $180,000, we'll say, well, that salary is no longer in the pool. It's either been replaced by a lower salary or not replaced at all. That's typically what's going on. Assistant professors, this category tends to have the biggest increase because when you bring somebody in, you bring them in at market or they're not going to come. Last time I looked, it costs more than $10 a month to live in Washington, D.C. I think the cost of living there is not exactly free. So if you're going to attract somebody to be a professor at American University, you better pay them. And so new assistant professors, when they are hired, are typically brought in at fairly high prices. So they become the new assistants become part of the assistant pool, which tends to make that pool get bigger. So that's why they have much bigger raises than the other pools. And we're going to talk about why this all ranks thing seems so much on the low side. We'll look at that. But in terms of inflation, over this 5-year period, the all ranks, you guys aren't doing well. We had a lot of inflation in our economy a couple of years ago. As I write here, assistants did best they can be hired in market. And here I'm talking everything I just said out loud, I have written in here. So this is where you are versus your peers. So among the 27 peers, your full professors, you're 15th. Associates, you're 15th. Assistants, you're 9th. Instructors, you're 12th. And all ranks, 19th. So AU does worse with all ranks than any individual rank because you have lower paid instruction as a mix of faculty driving the average down. So in other words, your mix of faculty is more, you have more of this category here than the tenure group, than the other schools, as I'm about to show you. This is the mix of faculty. This is the mix of rank. So of the 27 peers, American has the smallest percentage of full professors in it, but you have the biggest percentage of instructors. So American versus peers hires more instructors and has less tenure, full professor tenured faculty in your faculty mix. Again, I know you guys want me to shut up and go home because all I'm doing is giving you bad information, is negative news. I'm just telling you what is. I'm just telling you the way it is. And I don't think you knew this, but now you do. And what do you do about it? I think to me, any university or research, an all-one university, which you guys now are, without new faculty hiring, without new assistant professor hiring, doesn't stay that way. So that's the way to frame it, I think. So here's a graph of the full professor salaries. I don't know what to say about that one. There you guys are. And these are the all ranks. Yeah, as soon as I'm done here, I'm going to send you this. And this is what we call, I don't call this, but others have called this, not me. My friends at Wayne State call this their swimsuit report, where they just kind of tell you what the numbers are and they sit silently by and let you guys look. I did not put the names of these people on here. First of all, this document is going to be a public document. It's going to be shared among everyone there. I don't feel the need to cite people's names. Secondly, the number of former employees, administrators you're getting paid here. I want to be a former officer at your place because you tend to get paid for life apparently. Former dean of law, former this, a lot of formers, a lot of part-time stuff. But I'll let you. And this may seem old. The 990 for the year ended June 30th, 2024 is due in 11 days. It's due in 11 days to the federal government. And that will have the calendar 23 W-2. The 990 that's going to be submitted or has been submitted in 11 days will have the 2023 W-2s. We'll have these numbers here. And I think these are high. Mean 475, median lower. This mean is being driven up by that $1.9 million. But in every year, the mean is higher than the median because it's being driven up by the higher salaries. But these are pretty high salaries. And okay, yeah, I always get asked, let me say, this is the last page of the document. Why can't we compare this to other universities? It's not that I don't want to compare it to other universities. When you look at these 990s, there's so much partial year stuff in here. There's so much interim stuff in here. There's so much different titles. It is almost impossible to compare the the top administrators at American versus the other peers. It's really hard to do. Even at the presidential level, it's hard to do. a lot of partial year stuff, a lot of bonuses that get paid. So it's really difficult to do. I think to me, it's best just to look at this data compared to what happened to the faculty and then let it rest at that. And that's where I'll let it rest. And we still have 15 more minutes left. Colors are inconsistent. Yeah, they probably are. Sorry. Yeah,
John, I'm gonna moderate some questions now since we have 15 minutes.
Yeah, I was thinking if there's any questions, let's go ahead and see who go ahead and use the chat feature or raise your hands or Howard, while we're waiting, I have a question about, so you mentioned the overall instruction is only 30, where are we at, 32% or 33% of our expenses is instructional.
Yeah.
How does that compare to our peers? Has that been, you
so
did that?
so let me the only comparison I did versus peers is this one here. The 32% that you're citing is the total expense, including utility costs, et cetera. What you see on the screen here is the salary only component of these expenses. Well, you guys are at 37, which is still not but different than the 33. And you guys are on the lower side. 30, if I did iPad spending, including the other stuff, the reason I focus on salaries, there's no hint of, oh, we included all this other stuff that's allocated costs. This is cash. These are cash salaries. But 32 or 37 is still on the low side. You can see it's on the low side. You guys are 22nd.
Is that because we have so many instructors and so few tenure line faculty relative to our peers?
That is part of it. It's because, the faculty base we talked about. It's also your average faculty, your faculty salaries, even taking out the part-time and taking out the instructor, just the full professors, the associate professors, the assistant professors. I mean, I'm sorry you asked, so I'm not gonna shy away from it. I know people don't always like talking about salary. Let me get to the salary comparisons. Where are my peer salary comparisons by rank?
There's not enough data here, Howard.
Yeah, well, it's right here. So look, you guys are 15th out of 27, 15th out of 27 associates. You don't have that many assistants, but you're ninth. So yeah, even among your tenure track people, you're below peer. And you also have a mix, like you said, that's heavy on instructor, and you also are heavy on part-time. So you put it all together, you put all that together, and it leads to the 37% figure, which I think is, to me, this is a disturbing. Where's my 37%? This one here. I think that's disturbing. I don't like that. I want that to be higher. Make that bigger. I mean, there you could see the peer mean and median of 44. I mean, yeah, that's the way it is, and that's unfortunate.
I think Andrew had a question, and I see Wendy has her hand up.
Sure. Thank you. Thank you, Howard. This is really great. Really grateful for this work and the context. I guess I also wanted to underscore the question now becomes help us understand, not how dare you. I think as you've given us some really important numbers to say, can you help us, administration, understand what's in this thing, particularly professional services and auxiliary. But I like the energy of saying, well, help us. And now we have some details. I guess if you were to pick, and you've already identified them, a couple, three top things to interrogate, I think you flagged them as we were going, and I would really appreciate you telling us what you think those three things to really understand would be and what you've written.
Yeah, I think number one, I would say to them, yes, the bond. I'd talk first. You guys are claiming the world is coming to an end, but the bond rating, though it got down, the bond rating, the outlook got downgraded. The bond rating itself did not, and they cited strong reserves. So since the reserves are so strong, tell us why you need to be, convince me, administration, why we would need to be making cuts when we've got $1 billion, when you admit and Moody's claims we have $1 billion of unrestricted money. Why are we doing anything? That's number one. Number two, why the cost to administration? We have it in various different slides. The number of administrators and the dollars paid to administration is so much higher than the number. And we see flat faculty numbers and we see flat numbers when it comes to dollars paid to faculty. Why are administrators getting paid so much more increases and number of people than faculty? If we have a problem with enrollment, why is administration up and faculty, number of faculty flat or down? And thirdly, I want to know why you're hiring so many outside people. Why is it? Who are you paying and why are you paying them? Why are you paying them all this money and what for? What are you getting out of it? And not in words. I mean, I hate to say this. I want to see numbers. The $120 million basically on auxiliaries. If there's this mix between, are they outsourcing the auxiliary function and is that part of it? Then show it to me. Just, you don't have to show me the contracts. This isn't a public institution. They're not going to show you that. But you can show me the numbers. You can give me a spreadsheet that says these are the top 10 people that make the top 10 items that make up consultants. These are the top 10 items that make up auxiliaries. Personally, I don't think they'd give it to you. My reading of, I don't live there. I don't work there. I've been by the campus. I've never been around it. But the way, I spend a lot of time looking at stuff here. I don't see them giving it up. That's my view. The only way they'll give it up is under pressure. If you could get 60 or 70 of you signing a letter saying these are the data items we want because we want to better understand. That's the only way. And even then, you may have to go around them. The only way to go around them, of course, is the board of trustees, and presidents and presidents tend to have a lot of control over what a board sees and what happens at a board meeting. So, but I still think I would try. You have to try, but the only way to try is to get a written document of a list of demands with 60 or 70 people's names on it. And how many people are on this call? Let me see. 26. Okay, 25 people. 25 people's names on it. And you're not asking. I think the initial ask is for information. You're not saying you need to do this or else. I think the first thing you ask them for is help us, like you said, help us understand. And what you're trying to do from a strategic point of view is change the conversation. They want the conversation to be, faculty, sit down with us, help us decide what to cut. You want the conversation to be, why is there so much consultant and management money and people here? What's going on here? Why is that the case? It changes the conversation about, and then you can have a fight with them over whether you should cut or not. I mean, that's a different. Though you're not going to convince them of the need to cut. They believe this in their hearts, but by changing the conversation, you can change their behavior. That's my opinion.
Wendy has a question.
Thank you. Howard, thank you very much for this informative discussion. I'd like to probe a little bit deeper on the interest rate swaps and credit default swaps. American has had a long history in this that goes back to the 1990s. My understanding is board members got us involved in some of these type of investments. I could be wrong on this.
You're probably not wrong on that.
Are we still involved in
No.
this kind of thing? And I'm sorry, you said no, we're
I
not?
don't believe I think they got out of the swaps. I think they paid a lot of money to get out of them.
More than 90 million has been in the reports. And that's probably higher over the decades. And that's certainly a part of this picture. But if we're not in that business anymore, then that wouldn't be one of our questions to ask for more
Oh,
information.
but I still think they should not. I think the question to ask though is why hedge funds? If
Okay.
you're not beating the market, why hedge funds? I do think that's a legitimate question to ask because the interest rate swaps is just one way of saying we're going to beat the market. We know the market. Hedge funds, what hedge fund managers do is they say, if you give me your money, American, we are going to earn a really great return for you and just watch us. Just give us your money and we're going to do it. My answer to that is you're giving them the money and they're not beating the market. Explain to me, administration, why the endowment return can't beat the market. And they're going to talk about, oh, we have these needs for cash. I'm not buying any of it. I just think they should be able to beat the market. And Rudy Fichtenbaum and I, some of you know Rudy's past president of the AAUP, and he's a now retired economist, but he's written a lot about this issue, and we firmly believe that the hedge fund industry has captured the private university sector in a way that's very dangerous. And that if things go tumbling down, they could really go tumbling down. And I'm not pointing to what's happening with the stock market yesterday and today. That's because there's reasons for that. But I just think when you invest in hedge funds like interest rate swaps, why are you doing this? Why are you taking such a chance with money that if you claim this is all so important? So I don't think it's irrelevant, even if I just want to know why you're doing this. Why do you have to be so risky? Why
Plus,
can't,
we have the documentation and the data historically that this has been a colossal failure.
yeah,
So that allows us to bring up this question. I don't think, John, AAUP should ignore this aspect of it. I think it's a very important aspect. Roosevelt Institute has done a lot of research, and AU has come up a lot with these interest rate swaps. And I tried to put some stuff in the chat, but this is just an issue for us to put on the table. Thank you.
let me say one more thing about that in terms of the investment strategy. You mentioned in your when you introduced the topic, board members involved. This is typically the case around the country. What happens when you start doing that, they're going to get really defensive about this issue, about the issue that just got brought up. I That should not make you hesitate from bringing it up, in my estimation. Again, I believe that the amount of money invested in hedge funds and interest rate swaps should be zero, zero. And you need to explain, administration, board, why it's not zero, because it has not worked in the past and it's not working now. So I do think it's an area, and it is confrontational, but I do believe it should be brought up.
Priya has a
Thank
question.
you.
Yes, hello. Thank you. This was incredible. So my question is just to make sure that I'm understanding what sort of the marching orders as we walk out of here should be in terms of expecting, like understanding the danger zones and sort of where we need to focus our energies and our vulnerability. So it seems like one of our biggest problems is this $1 out of $6 going to the professional services and fees, which is why, getting a letter and requiring transparency would be helpful. And so I just want to ask if there are any other like obvious danger zones and vulnerabilities, other than that and the international student drop that we should really kind of be zeroing in on.
And the management, the number of management employees, the dollars paid to management employees. Why are the dollars and number of management employees going up while the dollars and numbers to faculty are flat or down? Why is that happening? Why are you hiring more managers and you can't hire more full-time tenure track faculty? If you claim enrollment is such a problem, why do you need more managers?
Okay.
I think that needs to be addressed. I mean, the number of management employees has gone up significantly versus and enrollment's going down. So you could say, okay, we don't need more faculty, we have fewer students, but why do you need more administrators?
Yeah.
I mean,
And then
really,
kind of just so sorry, one quick follow-up to that with the endowment issue. So that, whatever 4.2% of endowment income that can sort of be used as unrestricted funds, is it legal to have that be used towards this, professional services and fees? Like, could that
there's not much, no, there's not much restrictions on what the endowment could do. I mean, as long as it's for a university purpose, they'll just say it is.
then they can it's sort of unrestricted, it's stripped. And
Yeah.
so that money could not be going towards scholarships, but could in fact be going towards like a Sedexo.
I'm sure they will say it goes only to scholarships. I'm sure they will likely say that the endowment return 100% goes to what you just said, goes to scholarships only. But to me, it's just one big pot. Whether it goes to, you could say it only goes to scholarships, but it's just one unit. It just one. It's still the case that one of every $6 is still going to consultants, no matter what you say. That's still the case.
I love it. So like putting an administrator on a stand is like putting a cop on a stand. So we should expect the test to lying. Okay.
Keep your expert, but I still think you guys should do all this. And I'm not look, they're not going to swoon. They're not going to agree, but I do think you guys could affect change and make the place better by changing the conversation. I do believe that. I don't think they're going to swoon and listen to everything and do everything you want, but I do think you can affect change. I really do believe that.
Okay, thank you.
The next question was from Carolyn Gallagher. She said, what kinds of things should universities hire consultants for, and what kinds of things should they not hire consultants for?
Good question. Uh, I don't think they need I can't imagine, given those dollars paid to administrators, provosts, and admissions people, why do you need an outside consultant on admissions issues? I don't understand why you need that. You should know your own. The people that work there should know the students, the history, where students are from, where you get them from. I don't see why you need consultants for that. Uh, why do you need a consultant to tell you who to fire and who to lay off? And do you need outside consultants to decide any programs that should be cut? Anything programmatic should go through the input process with the faculty involved. So they should not hire consultants that have anything to do with what faculty do, which is give advice on programs and things of that nature. So those issues, I think, should be off base. You could hire consultants. What could you hire them on? You do have to pay. You typically do pay uh, investment managers to run your portfolio, just to manage the money, to put it in the right accounts and things of that nature. I mean, that's okay to pay someone a very small fee, a percentage of the endowment of the investment portfolio. That's okay to pay an investment manager. Your CFO may not be an investment manager, though she or he may have some expertise. But that's the kind of one that I think is okay at some level. But other than that, uh, you have employees to run the university. Uh, you don't need consultants to decide what classes to offer. You don't need you don't need consultants on scheduling issues on when you should schedule classes. You don't. I mean, I think you guys know how to. Don't you guys know how to do that? I mean, I think faculty do that? I hope.
And then the last question is that I have is from Marianne. She said, is 9 million for top administrative positions a reasonable number or unreasonable?
Well, here's the way I view this. I mean, that's a good question. I still think the admin costs over time at the university are high, and compared to other universities, the admin costs tend to be on the high side. When I look at these numbers and I look at the faculty numbers, when I look at the means, just look at even the medians of these top 15, 20 people in the 300,000s range, and I look at the faculty, at the average faculty member at American, the average all ranks faculty making 119. I think that's too big a gap. That's my view. I just don't see it. Their answer is we work 12 months, you work 2 days a week. Uh, we all know how to address that issue. I just think I'm sorry. I think a $200,000 gap between administration and salary and faculty is too much. That's just my view. I think the administration should come from the faculty. There shouldn't be that much of a difference between these salaries and what faculty are paid. So that's how I look at it.
So Howard, actually, I was going to ask about faculty salaries. So transparency is great, but we want to push to increase faculty salaries. Obviously, some of the salaries are baked in because it's non-tenure track salaries who are cheaper. Is there a pragmatic way we can push for increased salaries across the board, or do we have to push for more tenure line salaries?
Both.
Yeah.
I think the more tenure line is probably easier and a better and a case that you'll get that the administration will listen to more closely than just pay us more money. That's my view. Not that you don't deserve more money. Your salaries are still lower than your peers. I'm no joking aside, it's incredibly expensive to live where you live. I mean, maybe you guys, maybe it's not. Maybe it's gotten better. Is it cheaper to live in DC than it used to be?
Oh.
I can't imagine it's that cheap. Maybe you guys are telling me something I don't know,
No.
but It's very expensive, Marion writes. Yeah. And the other thing is, why do you have to pay? The other thing on the admin side, why do these people get contracts for life? Why do they keep getting off for the next several? Why do you, when you hire administrators, why do they keep getting paid after they no longer work at American? That's what I'm not quite understanding. Is that what it really takes to hire administrators? You have to promise them money for several years after they leave? I think that's a practice that's not appropriate.
But are they really not working at the U anymore? Like normally the provost, I think, is faculty now. Am I wrong?
They probably pay. My guess is some of that salary as a former provost is built into their contract that you get for the next 5 years. You get an extra $40,000 or $50,000 or something if they're still there as faculty. I don't see how that. I'm not seeing that. I'm not seeing how that is necessary to do. But and it leads to what you see here. It leads to this difference. It leads to this being, these 380,000 versus 110. I just think it's a huge difference. Yeah, other private. Yeah, is $9 million a lot for 19 people? Where the average faculty salary is 110, the answer is yes. And it's not just the average faculty salary, if I may. There's also other workers at the university. If I look at these other salaries, these are the total dollars paid. Where's my averages? These guys here. I mean, if you look at the averages of these people, if we did the average of these group, we're talking $50,000-$60,000 a year for a lot of this group here. So, yeah, all the other employees, why are you getting so much more? So, all right, terrible.
Are there any final questions or additional questions for?
I do. I do. I'm just wondering, like, so are these salaries comparable to those? Like, is this like if we bring these numbers right to the administration, are they just going to say, look, it's the going price. You want a good development person, you pay them $740.
They will say exactly right. When I look at these numbers, if I looked at your peers, these are not different. They're just not. My answer, Marion, your point is well taken. I think they're all. That's exactly how this is why it's like a self-fulfilling prophecy. That's how they use this piece of paper to pay people. This is what they use to pay, the vice president, the university, your lawyer making $471,000. I guarantee you a lawyer at Vanderbilt's making this, the top lawyer at Vanderbilt's making the same thing. There's no doubt in my mind if I took these numbers elsewhere, they're not going to be that different. I still think that doesn't make it right. And that's a hard, that's a hard one to.
I mean, if it works, right? I mean, we need development and we also clearly need undergrad enrollment. So, if your undergrad enrollment solves the problem, then, they're well worth their $550. Since that's, so,
when I look at where's my endowment, when I look at the endowment, I see how much, let me look at the endowment to show you how much it's going up every year. I want to look at what they're actually raising. And these guys have a lot to do. They have balloons to blow up at parties and stuff like that. I'm being mean, but I can't help it. Where's my endowment? Where's my endowment? Endowment 20. Okay, email table of contents. There we go. And here we go. So contributions to endowment, 7 million, 11, 4, 6, 11, 13. If they broke out fundraising expenses, I wonder how much of this, what percent, they're not raising a huge amount of money. They're raising this is what I would look at, is how much they're raising for what. But development people, they get paid at a place like American, they get paid $500,000. There's no doubt.
well, this is 3/4.
Yeah.
750.
750. That's what they get paid. They're going to get paid that somewhere else. They are, and that's all they use. But of course, the argument that you make to that is okay. If that's the argument you're making, then why can't? If you guys get paid that way, why can't we get paid that way? When I look at the faculties, why don't we get paid closer to the middle here? Why doesn't this close to the middle here? If you're paying your people that way, pay us that way.
Right. That's I think a better argument. One of the things I've been thinking about, and Ohio University AAUP had a really good analysis of, the presidential cabinet salaries are actually set largely by boards of trustees, who then use those high salaries to argue that's the market, but they're establishing the market themselves
It's a self-fulfilling
and
prophecy.
using it to justify paying
They use that.
people.
That's what Marianne was saying. They use that piece of paper I showed. This is what
Goes around.
It's a circle, but you got to change the conversation by pointing to this graph and saying, okay, put us in the middle then.
Right.
Put us in the middle. If your admins are in the middle, put us in the middle.
Right.
So.
Yeah, I think that's the argument we need to make.
All right. Well, it's good. I appreciate you guys doing all this, and I'll send you. There was one or two things I have to change. I saw one typo. I saw the X instead of a C somewhere. I'll change that, and then I'll send it to you as soon as you'll have it by the end of the day today. You'll have this document and do what you like with it. You don't have to ask. You don't have to ask me whether you can share it or not. It's yours to do what you want.
Thank you, Howard. Howard, can you also draft a short memo of key points that we can use to expand, and maybe we'll probably issue a memo ourselves, but this would sort of get us started. Like the high level main points that you think are jumping out from this.
Okay, I'll do so. All right, sounds good.
Thanks, everybody. Appreciate it.
Take care.
Have a good weekend.
Thank you so much.